Hello everyone and welcome to today's economics lesson. If this is your first time on this channel, you are highly welcome. Kindly subscribe to the channel, like this video and turn on the notification bell so you don't miss any economics lessons. In today's lesson, we will be looking at a very important SS3 topic in economics titled Elementary Theory of Income Determination. I repeat, elementary theory of income determination. This topic is very important for WAEC, NECO and JAMB examinations, and I want to advise you to pay close attention, take notes and also pause the video where necessary. By the end of this lesson, you will understand how income flows in an economy and how it determines the level of economic activity. So let's look at the lesson objectives. By the end of this lesson, you should be able to explain the circular flow of income. You should be able to explain or identify factors affecting the circular flow of income. And also, you should be able to explain the meaning of savings, investment, and consumption, and also understand the relationship between these three key words. So let's start with the meaning of income determination. Income determination explains how the level of national income in an economy is decided at a particular time. In economics, national income refers to the total value of goods and services produced in an economy within a given period of time, usually 1 year. Income determination focuses on how this income is created, how it flows, and how it is finally spent by different economic agents. So, income determination looks at the relationship between the household, firms, and government. Households provide factors of production such as land, labor, and capital, while firms use these factors to produce goods and services. In return, households receive income in the form of wages, rent, interest, and profit. So, in a simple economy, income is mainly determined by the level of spending. Now, let's look at the meaning of the circular flow of income. Circular flow of income refers to the continuous movement of income, goods, and services between household and business, that is firm, in an economy. It shows how households depend on firms and how firms also depend on household. Income is earned or income is spent and returned into the economy. So circular flows of income explains how money, goods, and services move continuously between household and income. Now, for easy understanding, economists first explain the circular flow of income using a two-sector economy. So they assume that there are only two sectors in an economy, that is the household and the business firm. Household and the business firm. Now, when we look at the household owns factors of production such as land, labor, capital, and entrepreneurship. They supply these factors. Households supply these factors to firms. Here are the factors we are talking about that is being supplied to the firms. That is the factors of production that we mentioned. Now, in returns, they receive income in the form of wages. Now, when they supply this to firms, the firm give them income. So, households receive income in form of wages for labor, rent for land, interest for capital, and profit for entrepreneurship. The roles of firms is that firms use these factors of production to produce goods and services. They pay household for the factor they use. Firms sell goods and services to the household. Now, the flow of income and goods are also in two ways. We have money flow and we have real flow. The money flow of income is the wages that is paid to the household. The wages that is paid to the household is the money flow of income. Whereas household spends this money, this income they received, the household spend this income on goods and services. You can see here, when the household received the income as wages, remember they gave what? They gave factors of production. Now, when they gave factors of production, they receive income. After receiving the income, they use the income to buy goods and services from the firms. And what does firm gives? Firm gives out the goods and services. That's the payment for the goods and services. Now, the second flow is what we call the real flow. Remember, the money flow has to do with the wages, rent, interest, and profit that is being paid to the household, and also the income on goods and services produced by the firm. That is the money flow. The real flow is a situation where the household provide labor and other factors to the firm, and the firm provide goods and services in returns. So this flow move in opposite direction but are equal in value. So what are the importance of circular flow of income? Circular flow of income form the basis of national income accounting. When you want to calculate national income, it is through the production activities that takes place between the household and firm is what they use to generate the figures for the national income. It also explains how income is generated and redistributed, and it shows the interdependence of the sectors. That is, we have two sectors, the household and the firm. And lastly, it helps economists to understand economic equilibrium. So what are the factors? Let's look at the factors affecting the circular flow of income. The factors affecting the circular flow of income. Number one, we have what is called injection. We have injection. Injection refers to any addition of money into the circular flow apart from the normal household spending. For example, investments or government spending, exports, aids and grants injected into the economy. So injection increases income and also increases the economic activities in an economy. The second factor that affects the circular flow is savings. Savings are the portion of income not spent on consumption. The portion of income that is not spent on consumption. You can even say portion of the disposable income that is not spent on consumption. What are the effects of savings? When people save more, that means spending or expenses, consumption will reduce. So the more you save, the less you consume. It also leads to a reduction in income flow, because when you save, that means the flow of money will reduce. And also lastly, one of the effects of saving is that savings slow down economic growth. When there is too much savings, it slows down economic growth. Now, next one is we've talked about injection, savings. Let's look at the withdrawal. Withdrawal is kind of an opposite of injection. Withdrawal refers to any factor that removes or reduces money from the circular flow. Example of withdrawal is savings, taxes, imports. So withdrawal reduces the level of income in the economy. The next one is investment. Investment involves spending on capital goods. Spending on capital goods such as machines, factories, and equipment. And the effect of spending on capital goods is that it creates employment opportunity. It also increases income and also acts as an injection in the circular flow. Now let's look at another point, factors, which is aids and grants. When we talk about aids and grants, we are referring to the funds received from government, international organizations, foreign countries. These funds increase the volume of money in circulation and thereby raise income. And lastly, the last factor that affects the circular flow of income is import and exports. Import and export. When we talk about import is this money spent on foreign goods. When money is spent on foreign goods, it means that the money is leaving one economy to another. Okay, so that is withdrawal, because the money is leaving an economy. That is withdrawal. Well, in export is the money earned from selling goods to other country, and that is injection. Export increase national income, while import reduce national income. So that is why most times Nigerian government encourages people to go into exports of goods and services. Now, let's look at the concept of savings. What do we mean by savings? Savings refers to the portion of income that is not spent on current consumption but is kept for future use. Or we can say that savings is the part of disposable income. You know what I mean by disposable income, right? So savings refers to the part of disposable income that is not spent on goods and services. So it involves postponing present consumption for future use. So why do people save? What are the reasons for savings? 1, to raise capital for business, to prepare for emergencies, for speculation purpose, to acquire assets. People save to acquire assets. People save for future needs like education or retirement. And also people save to improve their social status. Now, what are the factors affecting savings? Number one factor that affects savings is the size of income. The size of income is the most important factor that affects savings. You all know that income refers to the money earned by an individual or household over a period of time, such as wages, salaries, profits, rent, or even interest. So the higher the income, the greater the ability to save. This is because basic needs such as food, clothing, shelter, transportation, and healthcare take up a small proportion of income as income rises. So when the income is high, there's possibility that we're going to have high savings. But when the income is low, we're going to have low or no savings. Take for instance a teacher that earns 6,000 naira per month. Such person may end up spending almost everything on basic needs like food, transportation, school fees, rent, and so on. But someone that earns close to 1 million naira per month can comfortably meet those basic needs and still save a significant amount of money. Another factors that affect savings is rate of interest. Rate of interest is the amount paid by financial institution to people that save their money in the bank. It is usually expressed as a percentage of the amount saved. So when the interest rate is high, people are encouraged to save. But when the interest rate is low, people are discouraged to save. In the sense that high interest rate makes saving attractive, because when you save, you're going to get more interest. So people want to save because of the high interest rate. So high interest rate increase savings, while low interest rate reduces savings. Now another point we want to look at is the cultural attitude. The cultural attitude here refers to the beliefs, values, customs, and tradition of a society regarding spending and savings. So if in some society people believe in savings, like what we have in Nigeria, what we call our job savings. And also some people are disciplined in terms of spending, and they tend to save more of their money. So if a society encourages savings, or if the culture of people value savings, people will tend to save. But if the culture of people has to do with encourages heavy spendings or having social gatherings, social party and so on, people will save less. Another point we want to look at is the government policies. Government policies can greatly influence the level of savings in an economy. Such policies like taxation, inflation control, interest rate policies, pension schemes, and saving incentives can influence or affect savings. When taxes are high, disposable income will be low. As a result of that, people will be discouraged from saving because they are going to have low amount of money on them. Also, when we have a policy like tax reliefs or exemption on savings, when there is tax relief on some certain individuals, such people are encouraged to save more money. So favorable government policies increase savings, while unfavorable government policies reduce savings. Now, the next point is the availability of banks and financial institutions. When people can easily have access to financial institutions such as bank, microfinance bank, cooperatives, and even mobile banking services, this may play a greater role in determining the level of savings. So when financial institutions are easily accessible, people find it convenient to save. But if people find it difficult to access the financial institution, probably those people in the rural area, such people will be discouraged to save. So when we have more financial institutions accessible to people in different locations, it will encourage savings. But when financial institutions are inaccessible or are few, it will discourage savings. So now let's go to the next point, which is investment. What do we mean by investment? Investment is expenditure on productive assets that is meant to generate income in the future. So we can say that investment refers to expenditure on productive assets made with the aim of generating income or profit in the future. These assets are not meant for immediate consumption, but are used to produce goods and services or to increase productive capacity. So investment involves sacrificing current consumption in order to enjoy greater benefit in the future. So in economics, only spending that increases the ability to produce goods and services is regarded as investment. So when we say investment is future oriented, investment increases productive capacity and it also leads to income generation. So when somebody is buying a particular machine, let's say someone buying a machine to produce bottled water, that is investment. But someone buying food and clothes is not investment. Those are referred to as consumption. So we have different types of investment. Let's look at these types of investment. We have three. We have individuals investment. Individuals investments involve household houses, and you decide to buy build house, vehicles, and personal business. So individual investment refers to investment made by private individuals using their personal income or savings to generate future income. These investments help individuals to increase their standard of living and ensure financial security. Example is building of houses, buying of vehicles, or someone starting a personal business, or someone buying a farmland for commercial agriculture. These are individual investment, and this helps to increase personal income. It also creates employment and reduces dependency on salaries job. Next one is investment by firms. This type of investment refers to investment carried out by business companies to expand production and maximize profits. Example: purchasing machines and equipment, constructing factories and warehouses, buying raw materials and semi-finished goods, or expanding production lines. All these are firms' investments. So for instance, a beverage company buying new bottling machines to increase output is making an investment. So firm investment encourages mass production. It also increases the employment level and also promotes industrial growth. Now let's look at the last type of investments: government investments. Government investment refers to spending on social and economic infrastructure to improve national productivity and welfare. Examples are roads, hospitals, schools, and electricity, and so on. So these investments do not always aim at direct profit, but to promote long-term economic development. Now, what are the importance of government investment? To improve the standard of living of people, to attract private investment, and also to enhance economic development. Now, let's look at the factors that determine investment. Level of income is one of the factors that determines investment. Higher income allows individuals, firms, and government to save and invest. It is the money that is saved that is used for investments. So a company with high profit can afford to buy new machines. When you make more profit, you can use that money to buy new machines. Or when an individual that is earning large amount of money and salary can invest, we have enough money to invest. So the level of income also determines investment. Another one is savings availability. Savings provide the capital needed for investments. So without savings, investment is impossible. Like we know that S, which is savings, is equal to I, which is investment. So a trader saves part of daily earnings to open a second shop. Another one is profit expectation. If investors expect high profit, they are encouraged to invest more. Low expectation discourages investment. So a firm that want to expand, we want to produce, they is expecting that the demand of a particular product is going to be very high. Such firm want to produce more of such product. We have tax level. High tax reduces profit and discourage investments, while tax incentives encourage investment. When someone is on tax holiday, or a firm is on tax holiday, such firm will be encouraged to invest more. Rate of interest. High interest rates increase borrowing. High interest rates increase borrowing costs and thereby discourage investment. Low interest rates encourage borrowing and investment. So when a bank loan has a very high interest rate, people will be discouraged from borrowing, which will affect investment. We have political stability. Political stability has to do with an environment that promotes investors' confidence. People will want to go and invest in a place that is safe. You cannot go and invest your money in an environment that is not safe. So when security of a place is safe, the place is politically stable, people will be encouraged to go and invest in that place. And also economic environment. I've said this earlier. Now let's look at the concept of consumption. This will be our last item. When we talk about concept of consumption here, we are referring to the spending of income on goods and services for the purpose of satisfying human wants within a given period. So consumption represents the total consumer demand in an economy and includes expenditure by individuals, firms, and governments. So consumption is the part of income that is not saved or invested. So types of consumption. Number one, we have durable goods. These are goods that last for a long time and can be used repeatedly. Example is houses, vehicles, furniture, electrical appliances. Another one is non-durable goods. These are goods that are used up quickly and require frequent replacement. Examples are food, clothing, water, etc. Or buying of rice or bread. Those are non-durable consumption. And the last one is services. These are intangible items that satisfy wants, that satisfy human wants, but cannot be physically touched. Examples are education, transport, entertainment, medical services. So paying school fees is example of consumption of services. Okay, so let's look at the factors affecting consumption. Number one factor is the level of income. You see that level of income affects all the key items we have been talking about, starting from savings, investment, and consumption. Level of income is very key. The higher income leads to higher consumption. So the more money you earn, the more you consume. And also, now second one is savings habits. If somebody have a bad saving habit, such person will not be able to save. You want to consume everything. But if you have a good saving habit, that means you consume less. We have expected future price. When there is an expectation of a certain price, a certain commodity to increase in price in the future, people want to buy more of that commodity at the moment. Another one is that tax rate. When the tax rate is high, or let's say the tax rate reduces, it will enable people to consume more because they have more money on them. But the tax rate is high, when the tax rate is high, that means it reduces disposable income. And also influence of others. Peer pressure, social influence affect consumption. So sometimes some people want to use some item because we want to meet up with societal expectation. Buying smartphone due to peer influence, buying iPhone and so on. Those could be a result of societal expectations. Those also affect consumption. And asset owners of assets consume more due to higher wealth. We have interest rates and business profit. So you can see that elementary theory of income determines a lot of things in the economy. It explains how income flows within an economy and how consumption, savings, and investment interact to determine national income. Understanding this topic helps students grasp microeconomic stability, employment, and economic growth, which are key areas in WAEC and NECO exam. So we have come to the end of today's lesson on elementary theory of income determination. In this lesson, we explain the circular flow of income. We discuss the roles of household and firms, and we also examine the relationship between income, consumer savings, and investments. At this point, I want to encourage you to go through your notes again, study the examples carefully, and practice the calculations, as this topic is very important for WAEC, NECO, and JAMB examinations. If you found this lesson helpful, please like this video, share it with your friends and classmates, and subscribe to the channel if you haven't done so already. Don't forget to turn on the notification bell so you will be alerted whenever a new economic lesson is uploaded. Thank you for watching, and I will see you in the next lesson. Keep studying and stay focused.